Hi, this is Charles Kelly on a Friday, ending the week where we've seen billions wiped off of the market price of shares and companies all over the world, not just in the UK, but in America, in Asia, and other markets in Europe, where we've seen you know, billions, literally billions, coming off the market prices of companies. And you might think, well, that doesn't affect me, but I'll explain in a while why it does. We saw the Dow Jones, the top companies in America. We saw that those companies, that index lost 1,000 points. Perhaps they said it's one of the worst weeks it's had in history. And whilst the markets have not dropped as much as some of the bigger crashes of 1929 and 1987, it's still bad. And when you look, America's still open at the moment, I think, and it's still going down. And you see the S&P 500 down 2.6%, Nasdaq down nearly 2%, FT 100 index, the FTSE down 3%, Nikkei down 3%, Japan, Shanghai down 3.71%, Hong Kong Stock Exchange 2.4%, and the DAX 3%. So these don't sound a lot, but those percentage points represent billions and hundreds of billions in this case, in terms of value of these companies. So these companies literally can just be worth that much one day, and suddenly it's sliding down by, in some cases, like there's companies in America that have gone down by 9.65%. AES Corporation, L Brand, Xerox Holdings down 6.5%. I know that the airlines in this country and the travel firms have been particularly hit in the UK by these falling values and lack of market confidence. And then you look at where the money's going from there. So if investors are selling shares, what are they doing with the money? Well, they're putting some into gold and silver, and that's why you've seen gold jump up this week. Then it come down a little bit, but it's still higher than it was a month ago. Or they put their money into bonds. But bonds yields, now bonds mean basically the major bonds, like the US bonds, the UK gilts, and that's what you're basically lending money to the government. But the yields are so low at the moment. I'm looking at yields here. US 10-year bond, the yield is 1.13. A 30-year bond, 1.65 yield. And on a 5-year, the yield is lower, 0.9, less than 1%. A 2-year, less than that, 0.87. So these yields are historically low, and this is affecting pension funds at the moment. It's affecting all sorts of investments. But in some countries, the yields have actually gone to negative. The Bund 10-year bond, it's a negative yield. Japan 10-year bond, a negative yield. In other words, you're kind of paying them to look after the money. It's incredible. There's even negative mortgages around. Eventually, we could, if rates keep coming down, and many people are calling for the Federal Reserve to reduce rates further. If rates keep coming down, we could see negative interest rates in your bank account. In other words, you're paying the bank to keep your money there. At the moment, they are very low, but they're not quite negative yet. So that's what's been happening this week, and we will have to see what happens. And even futures and commodities are all down. Oil down 4%, natural gas down 3.4%. Gold, well, gold was up, but it's crept down a bit today, 3% down. Silver's gone down a little bit as well, but it has been up in the last week. So it's not completely disastrous. But even wheat and copper and these sort of things are also down. So I think silver's down 6% on the day, but it has been up. I expect people have been buying and selling. But definitely gold and silver has been on the way up for the last couple of years, and have certainly done well. Although gold and silver, if you just buy gold and silver, you don't really get an interest yield on that. So there's been some corrections there in those prices. But gold has posted a weekly gain, but perhaps down on the day. So that's what's been happening around the world, and some commentators have called for more of a calmer mood. That this is not completely disastrous. That this has got to be looked at in context of how many people are actually infected, and where you compare this with other diseases such as flu and other viruses where people die every year, and how many people die on the roads every year. This is quite a small thing, but then you look at it and you say, well, 86,000 people are infected around the world, and a few weeks ago it was a lot less than that, and now it's spread to every country in the world, right? Not every country in the world, but almost every continent in the world, every part of the world. It crept into Africa in Nigeria. Just today we had a British fatality, the first British fatality of disease. This was someone who was on that Diamond cruise, and in Japan, where they were quarantined on the ship, and 500 or 600 people come off with the virus, and somebody's died in Japan. So that's obviously very tragic. But we're seeing in Europe now, Italy, France, Germany, having quite a number of cases, and we're seeing events being cancelled. The Geneva car show motor show has been cancelled. That's a massive event for the car industry. Sporting events have been cancelled. Meetings have been cancelled. So this is the reason the markets are going down. They're reacting to the fact that this will have a knock-on effect on business for months to come, and the fact that a lot of components, a lot of things are made in China, that people, companies will not be able to get those components now. That's going to delay production of all sorts of things around the world. We heard about Jaguar Land Rover in the UK, how they couldn't get parts, and this will have a knock-on effect. There's no doubt about it, that even if they sort this out pretty quickly, it's bound to have a knock-on effect on economic activity and growth all around the world. And the former the outgoing Bank of England has said that this will change the economic forecast for the UK market. And of course, in between all that, we've got the Brexit negotiations going on as well, which haven't really been mentioned much in the last few days because of this coronavirus situation. So all you can do, and you might say, well, okay, what's that going to do with me? I don't put my money in the stock market. Well, perhaps you don't put your money directly in the stock market, but if you've got a pension scheme, that will be in the stock market, and a significant amount of that money will be directly in the markets, perhaps in shares and perhaps in bonds as well, if you're a more cautious investor. And even if you've got a company scheme, the underlying assets within that company scheme, like your employer scheme, will mostly be invested in shares and bonds. So they are affected by the market, and it will also affect economic activity, economic growth. It will affect the amount of investment that's available to go into new projects, which then go on to create jobs, etc. So it has a knock-on effect for everybody, whether or not you're an investor in the market. And just there's a bit of news here. 10-year Treasury yield collapses to another record low of 1.12%, and the 2-year yield is now 0.9%. So because more money is going into bonds, the price of bonds are going up, and that means that if the price has gone up and the yield is the same, and the return or the interest they're paying on that bond is the same, the yield is in effect going down. So in other words, if you buy a property and you're getting 10,000 a year rent, that's a 10% yield. But if you bought that same property 5 years down the road and it costs £200,000, but the rent is roughly the same, that's only a 5% yield. So the value of the asset's gone up, therefore the yield has gone down because the interest paying on that is very low. So there you go. Other commentators are saying, well, if governments can borrow at these record low rates, why they're not borrowing to fund infrastructure projects? Yeah, that's a good point. But the infrastructure projects have got to give some return to the economy, so that these interest rates are still going to be paid, whether they're low or not, and the money's got to be paid back at some time in the future. So there we are. I think there's not much I can say other than that it's been a very difficult week for the markets, and other things we saw. On a smaller scale, we talked about broadband providers charging customers to keep email addresses. We talked about a government scheme launched to protect homeowners against shoddy builders, and then we go back to most of the news this week has been dominated by the FT market and the Dow Jones index falling. The other day I said that the stock market in the UK, the FT 100 index, suffered its biggest drop in 4 years. Now, some of these drops, I mean, the Dow Jones has lost 1,000 points on the week, just, not so long ago, and it was one of the biggest drops since the market crash in 2008. Now, a lot of people are saying that we're due for a correction anyway. It's been more than 10 years since the market has roughly been sort of going upwards, and we must be due for a correction. However, other people say, well, the markets are not much higher than they were even before that period. Even 20 years ago, the FTSE was around about 7,000, and at the height, not so long ago, it was 7,500 a few weeks back. So it's not gone up that much. Now the companies within the index have changed, of course, but then of course it's gone down from 7,500 down to at one point less than 6,500. So we shall have to see. Nobody knows when the market. Nobody can really call it, but it's obviously very volatile at the moment. So I'm not giving you financial advice. So you've got to go and talk to your advisors and see what you want to do with your investments, your ISAs. If you've got an ISA, if it's sitting in cash, then it might be tax-free, but the interest on that ISA, if it's only 0.5% and you're a basic rate taxpayer, it's not really doing you that much good because you're hardly paying any tax on that interest anyway. Maybe, if you wanted to get a higher return on that ISA, you'd have to look at a stocks and shares ISA where you can have some assets in there that might be producing something in the long run. But again, you've got to talk to your financial advisor about that and see what your financial advisor says. So thanks for listening. This is Charles Kelly, author of Yes, Money Can Buy You Happiness, a book that teaches you how to accumulate more money, to manage your money, to be happy with your money, and to appreciate your money, and how basically how to look after your money. It gives you lots of tips on making money in the book, and you can find that on Amazon if you're interested. So thanks for listening, and have a great weekend ahead. Thank you.